Hi, good evening, everyone. Thank you for joining the India Outlook 2022, the Road Ahead session webinar today. In fact, we did the couple of days back, we did the webinar, and it was really an enthusiastic response that we got from our participants. And so we are overwhelmed to get here and joined by the expert as they discuss what the future holds for India and the journey to becoming the 5 trillion economy. My name is Karun Mutha. I am SVP Insights at HSBC India. Well, we are aware of an ambitious target of India making into a 5 trillion economy by 2024. The pandemic might have slowed down, but hasn't stopped us from aiming high. In our previous episode, a two-part series, we looked at some of the macroeconomic and macro market fundamentals and how India may shape up and proceed towards the recovery, given the right enablers, not only from the investment community, but also from the government and the policy makers. Today we have again with us today market experts, two eminent people joining us today. First, I have with me is Mr. Sanjiv Duggal. Sanjiv heads the Asian and Indian equities at the HSBC Global Asset Management. He joined HSBC in 1996 and was responsible for the management of Indian equities. He moved into the current role in August 2013, and prior to joining HSBC, he worked for Hill Samuel Group, where he spent nearly 5 years, initially in the internal audit and later as an emerging market fund manager. Sanjeev is a chartered accountant. Please welcome Sanjeev. Our second speaker for the day, of course, a very eminent personality, and you know him all, Mr. Raamdeo Agrawal, Chairman Motilal Oswal Financial Services Limited. He has been instrumental in evolving the investment management philosophy and framework. A recipient of Rashtriya Samman Patra awarded by the Government of India, he is also the National Committee of Capital Markets of the CII. He is an associate member of the Institute of Chartered Accountants of India. Well, before we begin with Mr. Duggal's presentation, a little bit of housekeeping before we get started. Please type in your questions in the Q&A box below, and I would address them post the presentation. And we will also have some questions at the end of the session from the participants to take it forward and moderated through the expert speakers. Well, time to hand it over to Sanjiv. Without much ado, I would request to Sanjiv to take over the proceedings. Over to you, Sanjiv.
Okay, thanks a lot, Karun. Thanks for the introduction. So what I'll do is I'll run through a few slides on India from an Asian perspective. And we're very interested to get your questions as well as we go through it, and we can address them at the end. So just going forward, I'll touch upon how Asian investors look at India. So I've looked at India from a foreign investor perspective when I ran the HSBC Indian Equity Fund from locations such as London, Mumbai, and Singapore, and now I'm based in Hong Kong. I've looked at India from a domestic mutual fund perspective when I ran the local HSBC funds quite a long time ago, but 2002 to 2005, when we first launched our asset management business in India. And now I look at Asian equity and look at India from a different perspective, because we're constructing a portfolio of Asian stocks, across the region, be it Australia, China, Taiwan, Korea, and India as well. So I'll just run through what we see. So just starting off, looking at the middle chart, middle part of the slide. Hopefully it's visible. There's a lot of data in here. But basically, if you look at the line moving up, it's showing you that the price earnings multiple of India is at a 60% premium to that of the rest of Asia. So India has done very well in 2021 in particular. And that is the highest premium, I guess, since we launched our domestic mutual fund back in 2002. So India, is being perceived very positively by investors, both in India, which is very important, and overseas as well. So looking at the left-hand side, you can see that just very quickly, the US market's trading at about 30 times price earnings multiple. You can see India's almost at US type multiples, given partly due to the breadth and depth of companies in India. And if you look at Asia as a region, it's about 14 times P multiple. And then finally, if you look at the biggest market in the region, it's China, which is trading at about 12 to 13 times P multiple. So you can see this big dispersion or spread between the valuations of different markets. So part of India doing well was thanks to China last year. So China had a lot of issues. So China is the biggest market in the region. It's about 40% of the markets in Asia. So 40%, so it's a big number. And China had a lot of issues last year. There's big regulatory headwinds. So the Chinese government and regulators changed a lot of regulation affecting the internet companies, which is the biggest sector in China, the high growth sector. And those stocks collapsed. They fell about 50, 60%. And some business models went to zero. So education companies in China, I know there's a big education company in India which is planning to come to the market, but the big education companies in China, literally the business model was effectively destroyed due to regulation change. And there were some other issues to do with the property sector in China. So there was some liquidity requirements or funding requirements that hurt the property market. Government tightened up policy in the region, in China, and that affected the property sector, which is a big driver of GDP growth in China. So a lot of that money went into India on a relative basis. Because if you look at the rest of Asia, there are limited opportunities to invest money in. Yeah, there's some big stocks in the Korean market. There's some big stocks in Taiwan and Singapore, and Hong Kong. But a lot of the other markets like Indonesia, Malaysia, Philippines, Thailand, have limited opportunities. So India was a beneficiary of the problems that China faced last year. The other factor, just looking at earnings growth, you can see India stands out. Looking at FY23 or calendar year 22. So we're looking at 21% earnings growth looking forward 12 months, which is one of the strongest you see in the region. Asia as a whole is growing at about 11%. So you can see that India is growing a lot faster. Yeah, you've got to be a bit careful because obviously there's been a lot of COVID impact, which has affected earnings or profits of companies, given that COVID has led to some shutdowns of particular economies at different points in time. So going ahead, so this slide shows you the dispersion or the spread of returns between different markets. So you look at 2021, you can see we've got the biggest spread of returns. So that's the start of the year in 2021. And you can see the best performing markets, like India was one of them, did a lot better than the worst performing markets. And China is one of the worst performing markets in the region. And that's the biggest dispersion or spread you've seen over the last decade. So there's a lot that was happening last year in terms of how different markets performed. And obviously within each stock market, stocks are doing, very different things as well. So within India, obviously the smaller cap names and the mid cap names last year did a lot better. So let me move on and I'll just highlight what we do at a stock level. And I'll touch upon India coming to $5 trillion. I can see Karun looking a bit worried that I've gone off track. But so what we're trying to do is, since India has done very well, from an Asian perspective, we're looking at companies which have good business models in India, but the market is perceiving them differently. So this is an Indian pharma company. The big issue the market has with the company is if you look at the red bars, you can see the amount of debt the company had or borrowings was very high. And the market was concerned because most of the other pharmaceutical companies aren't in the situation. They have less debt or they might be cash positive. So our view is this company is changing, and you can see it's slowly coming to cash positive in 24. So the business is generating a lot more cash. The company has sold some assets to realize money, and they're a lot more focused on spend and opportunity. So we think this company trades at, for example, a P multiple of 11 times forward earnings. The Indian market is 25 times. And we see one of the big issues being resolved, that debt or borrowings is reversing and going into a positive. The other big thing that we look at is sustainability, or ESG, environment, social, and governance. So for this particular company, we can see that governance standards are improving. The company has recently appointed 2 external candidates as CEOs of 2 of its key subsidiaries. The company is making a lot more disclosures to the market, and our view is that the market will eventually recognize that. So that's one type of company that we invest in. So good business models, but undervalued. And the other business model we invest in and that links into the $5 trillion economy, is a lot of these new platform-based companies where we see a very big addressable market, be it, I don't know, food delivery, e-commerce, and you've seen some of these companies listing in the Indian market. So we see those as very good long-term opportunities to invest in, albeit they're quite expensive right now as you look at it. But based on our experience of investing in China, Korea, and other markets, these companies have always been expensive, but the growth they generate has been quite tremendous. So we're taking a longer term, a 5-year view. And I know Raamdeo has this analysis that he does of the winners in the Indian markets. And we think over time, some of these companies could appear potentially in that list. Going on, healthcare. You can see India's spend on healthcare is quite low. We think there could be some further measures, in the upcoming budget on healthcare in particular. But you can see the growth for India, it's one of the lowest as a percentage of spend on GDP. See that increasing, as we go forward in time. Since I've got a slide partly on GDP, so our view is that India should be able to get to $5 trillion. We think the economy should grow at about 7% per annum, real economic growth. If you add in inflation, take a little bit of, say, 5%, subtract a bit for rupee depreciation, because you're talking about US dollar 5 trillion. Yeah, our view is India should get there in FY25. So by March 25, India should be that $25 trillion economy. So the things that are helping, one is government policy. So you've seen over the past few years, policy change, so coming back to demonetization, which was a big change in the economy. So trying to get more people towards away from cash. So, a lot more activity gets recorded in the economy. GST, which again helps to formalize the economy. A lot more of the economy is getting recorded. And it helps obviously a lot of the listed companies, which are part of the formal sector. And then you've had things like the Real Estate Act. And you've had the recent schemes on performance-linked incentives as companies put up new facilities. You're getting these tax incentives. So we've seen a record number of Indian companies being set up in India in the past year or so to avail of these tax benefits. And obviously corporation tax rates have been dropped as well by the government. So a lot of these things are quite sort of help the whole investment cycle. And I mentioned some of these new business models or platform-based economies, food delivery, e-commerce. So a lot of those companies are attracting foreign capital. So India's seen record amounts of foreign direct investment coming in, obviously local direct investment as well, people investing in new areas, so a lot of fresh capital coming into the market. And I think those are the ingredients that will take India up to $5 trillion in 2025. The key thing is the market reflecting, how much of that is the market reflecting? And I guess we'll discuss that as we go forward. So going on, I'll skip these slides. So the other thing which is quite important is trying to get better governance, better practices in Indian companies. So when we invest from a foreign investment angle or even locally, the key thing is now is responsible investing. So you got to really look at the broader community. Yes, returns to investors like you are very important, but it's how you get to those returns and how you can drive positive change in companies to get to that result. So we spend a lot of time in looking at ESG issues, so environmental, social, and governance. So we've got another example here. which has been quite topical in India, of a media company in India. So we've been invested in this company for a couple of years. We've actively engaged with the CEO of the company and who is a promoter of the company, and trying to drive change in terms of connected party transactions, better disclosures, and eventually for this particular company, a couple of directors resigned towards the end of last year. And you've seen the share price off the lows I guess towards the end of last year, the share price double. So that's the importance of ESG. And again, that'll help India attract more capital as ESG gets better for Indian companies. So I think I will stop there and hand it over back to Karun.
Thank you, Sanjiv. I think we will take it more in the Q&A session, and thank you for that really guidance on kind of growth that we are possibly seeing on the Indian economy, particularly with respect to the earnings and the earning growth that we are seeing. Of course, I will have some queries on the valuation because that seems to be slightly stretched, as you did mention about a 60% premium to its peers and the other emerging markets. But let's hold that thought for the Q&A session. I would now invite Mr. Raamdeo Agrawal to share his thoughts on India perspective and what does he see the roadmap towards the 5 trillion economy. So over to you.
Yeah. Good evening, friends, and thanks to HSBC for giving this opportunity to speak to all the valued customers of HSBC. I'm not much of a macro guy. I look at the stocks and in individuality. But some of the things which are big trend, because 2022 is a year of big stuff. I mean, last year has been clearly a lot has been happening, and equity markets have been surprisingly. If you ask at the beginning of the thing, I mean, the amount of fear which I had. I mean, it was a black swan event, and February. I remember February 3rd week. We made literally all-time high, and March 3rd week we made 40% lower market. So that's the nature of the market, and today we are sitting 30-40% higher than the pre-COVID. Pre-COVID was about 12,500, and now we are at about closer to 17,500, 18,000. So almost 50% higher than the pre-COVID. So I would have not been able to say that looking back 2 years back that this could be the outcome in next 2 years. Almost impossible. But when I look back and see what are the things which are worth noticing here, one is, of course, the positive side is that market is becoming very inclusive in terms of retail participation. I mean, it's absolutely a revolution in terms of the pace at which the customers are coming. In January 2020, total Demat account was 40 million. This is like in 50-60 years we could get 40 million accounts. You see how narrow was the market. And December 21, it has become 80 million. And monthly ads in 2020, January was 1 million, and December 21 is 3.5-4 million. And it's still rising. And I believe LIC issue on the eve of that, we might get another 30-40 million accounts adding on to the system. So I think just the breadth of the market has been changing, and it would have not been able to, nobody would have been able to predict. We are one of the largest retailing company, and yet we are completely surprised by what is going on right now in terms of new client addition. So that, and it has a deep repercussion in the market structure and what happens to the stock prices also for mid and small, the kind of boom we have seen. One of the reasons is that participation by the retail. Second is that my sense is this 80 million is going to go to more like 150 to 200 million in next 2 to 3 years. So then you'll see even further broadening of the market, and this will make market more efficient. And also, I don't know how the behavior of the market will also change, because retail behaves very differently. They are more sentimental, less informed. Institutional investors are more I would say informed and less sentimental. So I think the structure of the market, behavior of the market, but I think it's a happy development that the market, the economy, more and more people are participating in the risk capital contribution to the economy. And I think the basic allocation of the household savings from say 2% of GDP, I don't have the exact number, but 2% of GDP out of 20% household savings could go to 3 or 4%. And that will have a huge impact on the entrepreneurship, the growth of the economy, maybe with a gap. But I think this is a big thing which is on. So that's a big positive, and which is going to continue for the next 2-3 years for sure. Second, collapse of fixed income in India and worldwide actually, and falling way below the inflation rate. So I mean, it is unheard of that you trade 5-6% negative spread between the inflation and the real rates. So that's more pronounced in the Western world, but in India right now maybe a percentage or two negative, but still you're talking about negative spread to the interest rate. So that has made the entire set of fixed income unattractive for the Indian investors who are very, very loyal to their fixed income portfolio. And hence we are seeing, along with the influx of retail, we are also seeing the HNIs changing their portfolio mix in terms of equity selection. That's a broad thing I'm seeing as far as the positive side is concerned to the equity. Other side is that very strangely, but the world is talking about decarbonization. They're fighting the carbon footprint. Suddenly, during the COVID problem, so one side you are struggling with all kinds of issues related with the slowdown and human tragedy and economic challenge, close down and all. And other side, suddenly, what should be post-COVID agenda slowly for 2030, 40, 60, 70, suddenly there is a massive fighting. I mean, there is a massive noise about the decarbonization of the planet Earth. And in the process, the investors are not putting money into the coal and oil and all kinds of commodities which are considered not good. But the consumption has not fallen. So what is happening is that because the investment is not there, but demand remains intact in a short period, the inflation of commodity is going to remain high, and maybe it may become worse, and it may remain very entrenched. So the inflation looks to be very entrenched because of the commodity and this decarbonization and commodity cycle, super cycle of the commodity. So that looks to be one big factor which is going against the low interest rate thing. Second, I think this is the year of withdrawal of liquidity and withdrawal of the stimulus, financial stimulus, unprecedented financial stimulus given by US, your coordinated worldwide stimulus which has been given, that will be withdrawn. And hence, my sense is that it's like US has printed $7-8 trillion of money in last 2 years. That has kind of that is one part of it, but the markets like US alone has printed about $25-30 trillion of market cap. So the total impact. So somebody was telling me that it is 1:7 types. So if you reduce the balance sheet by $1 trillion of the Fed, probably markets will tank by 8-10 trillion. But that mathematics doesn't work like that. When you start going down, then it can be very disproportionate because there is no formula that will be 1:8 or 1:5 and things like that. So I see a problem in the global equity markets, and some amount of correction, which was overdue, should come during this year. Then another thing I see is that the relationship between China and USA. So whatever is the commercial relationship, but I see a two-polar world where Americans are withdrawing their liquidity and they are trying to control the inflation. Whereas if you see China is just doing the reverse, in the sense that Chinese central bank is actually loosening the monetary policy, and they have cut the rate by even 5 or 10 basis points, which is maybe nominal, but they are going on loosening the monetary policy to get the growth back. I mean, if you read the articles, what I see, they're not talking about inflation, they're not talking about negative interest, they are just focused on single thing, that is getting the growth right. So last year in 21, they grew at 8%, which is staggering on a $15 trillion economy. but the last quarter was 4%, and that has triggered a counter-cyclical kind of measure and loosening of the monetary policy. So I think one side you will see China reducing or at least staying back with a loose monetary policy, and the rest of the world are tightening the monetary policy. So I don't know how the markets will react, and how the commodities will behave, how entrenched will be the inflation. So there are a lot of questions unanswered in my mind, and it will unfold slowly as we go into 22. But my sense is the bigger call is that 22 is a year of correction of the monetary policy and liquidity, and hence even the equity valuations will broadly see correction, and our returns, what a bumper in 21, would be far more muted. I would be surprised if we, I mean, the best would be 10% plus, and I hope the worst is not more than minus 10%. So that's the kind of thought process I have. And but while seeing the presentation, I was wondering, is it possible to buy low and sell high? But I think this is the biggest mirage in the market, and we might say anything, but it is very tough. When you look back, then you realize that how wrong you were in the markets. So with this, I'll close my remarks and we'll get into Q&A.
Thank you, Raamdeo sir, and that was really exciting because you clearly highlighted the risks that are emanating into the markets, and perhaps we have to be wary of the fact that liquidity, whenever withdrawn from the global markets, will definitely have an impact in the global asset class, and we have already witnessed that earlier. We call it 2013 tapering, but of course we'll have to see how does it go forward ahead. I have certain questions that have really come to me, and I wanted to start with straight away with Sanjiv. Sanjiv, I think the biggest concern of the wave which has washed across the region is that the growth may be knocked back. While inflation pushed higher with Omicron, the macro narrative for global economy and Asia, particularly this year. So, what do you feel about the global growth that has really been jumping guns, and maybe we will see some sort of pushback on the growth?
Yeah, so I guess our house view is that we think growth should be reasonable in this particular year. As Raamdeo mentioned, yeah, I guess the most interesting market from that perspective is China, because growth has slowed down quite dramatically. There have been a lot of headwinds in China, which I touched upon, regulation to do with the platform-based economy. There's been liquidity tightening for the property sector as well. So we've seen the Chinese market slow down, and the government, China had been tightening policy last year. And as Raamdeo mentioned, in the past few days, they've started to ease monetary policy. And they've also got scope to take fiscal measures to spend more money to boost the economy. And I guess the risk, just coming back to India, the risk for India from that point of view, if money flows into China, the stock market, then that money's got to come from somewhere. Just looking at the regional markets or emerging markets. So China is the biggest market. It's about a third of the benchmark of the index for Asia. So obviously, if China starts to do well, and if you look at a day like yesterday, a lot of the big Chinese companies, the Tencent, Alibaba, Meituan, so food delivery, e-commerce, social media, gaming, I think they're all up about close to 10% in a single day. So people are very underweight China. If I speak to the HSBC China fund manager, I think maybe 5-6 months ago, she was very negative China, and she had held a lot of cash. But right now we've changed our positioning, and she's invested a lot more money. She's incrementally getting more positive on China. And even for us, from a regional perspective, Asian perspective, we're now putting more money back into the Chinese market. And obviously, if clients don't give us money, hopefully clients give us more money to manage. Otherwise, you've got to then take it out of a particular market and then put it into China.
Sure. So Sanjeev, I think you rightly made a point in the beginning of your presentation that, and I would really draw your attention to India being quoting at 60% premium. Now, I want to really check with Raamdeo. The pace of consumption growth is likely to be moderated in the current year, as you rightly mentioned, because it's all of the pent-up demand that actually picked up the markets or the economy. Considering the stretched household balance sheet,
I think it is. We are always happy with 21, 22 times. Multiple for India is not looking bad fundamentally.
Hmm.
But when you put in the perspective of comparing with other markets, I would
Hmm.
consider that there are only three markets India should be compared with. Either US
Hmm.
as a large economy, very rich. I mean, you cannot get away from US is mother of all the markets. So US is one, and other side China. But China's
Hmm.
character, I mean, China and us, we are like 1.4, 1.5 billion people, and so one cohesive market. So the growth potential for India as well as China, I would say growth potential, if right policies are followed, India has a much more sustained growth possibility. And the quality of companies,
Okay.
quality of entrepreneurs are very different order. I mean, you have the duds clearly in utilities or PSUs and all, but on other side, you have world-beating companies. And
Hmm.
those companies are very transparent, and
Hmm.
they're as transparent as companies can be any part of the world. And
Hmm.
a lot of them are global. And now I
Hmm.
think internet being, I mean, ex-China internet, like the rest of the world internet, India is integral part of that internet. So I
Hmm.
think a lot of the digital companies will come from here, or Indian companies will go
Hmm.
digital, serving almost the entire world. So I think Indian IT is about 25% of the total, kind of corporate profits and economic activity. Your
Hmm.
financials, insurance and banking is about 30%. So 55%. So the character of the market, I don't actually, my problem is I don't know China that well. So,
Hmm.
but looking at India, I mean, going by Sandeep's own number, like 19.3 times 23
Hmm.
is, I mean, can it be 17, 18? Yes. I mean, there is a scope for correction. But beyond that, I
Hmm.
don't see much, happening there. In the sense that I would be pretty comfortable, say 17, 18 P multiple 23. My sense is earnings growth itself, which is projected to be about 14%. Uh,
Hmm.
let's see the budget. How does it work out? How, I mean, my sense it could be higher than 14%, but I think there's a consensus estimate is good. For that
Hmm.
also, so I'm pretty comfortable with a bias that yes, in the global sell-off, we can see 15-20% correction in the market.
Correct.
Yeah,
Absolutely. You said it right. I think, yeah, Sanjay, you were trying to make a point.
I was just saying, sorry, I don't know, but you can see my screen, which I put back on the on the presentation slide. But yeah,
Okay.
so when we talk about 23, just to
Hmm.
clarify, no, I'm talking about FY24 effectively. So that's
Okay.
March, yeah, that's December 23.
Hmm.
Just to compare everything on a like-for-like basis. I know India,
Hmm.
obviously, it's March year end, but
Absolutely.
23 is December 23. Just to
Fine.
clarify. Yeah.
Fine. Right. Thanks, Sanjay, for that. No, I think, but surely Raamdeo made a compelling point that the growth that is really being envisaged, and particularly for the formalized sector like an IT or a banking, wherein you have such a moves taking place, wherein the exports are really robust. There seems to be a kind of growth that is going to be evolving and erupting, and probably that would really make the consensus earnings look better, and perhaps the earnings more moderate. That's what it looks like. So coming back to the global part of it, and particularly when we are talking about the global tapering and inflation in particular, inflation seems to be, Sanjeev, a more complicated animal, following the output disruption and the swift rebound, which could stroke the price pressures for the longer term rather than transitory, what is being talked about. Like, even though the economic growth in the current year could be one of the fastest in the emerging market, the output gap is slightly negative. So what are your views on that, particularly the inflation part of it and the output gap being negative?
Okay, so I'm not an economic expert, but yeah, so I mean, the way we see it, as Raamdeo mentioned, in China, I guess growth is a focus. So you can see the government policy measures are more towards easing policy. In India as well, I guess it's less of an issue. So the key thing is availability of labor. in India. Globally, I guess a big thing has been supply chain. And given the disruption due to COVID back in March 2020 and the subsequent waves, that's led to a lot of disruption in supply chains. So our view when we look at it, I think companies are now putting up new capacity in some areas. Obviously, in areas like coal and oil, there's a natural tendency not to invest more in these areas because people are moving into alternative energy. So at some stage there could be a squeeze on energy prices, because as you transition, it's very hard to plan it on a global basis. So people aren't investing in new oil and energy. That transition is not going to be a smooth one between fossil fuel based energy, coal and oil based towards alternative energy. So it should be interesting, but I guess our house view is it's more transitory. We will see tightening in or interest rates going up in most of the rest of the world, and with the US as well taking quite a few hikes this year, next year. We've seen some Asian economies taking up rates as well. Indonesia earlier this week as a preemptive measure. Korea has done it, I think, 2 or 3 times in the past few months, whereas China went the opposite. But for us, the key thing as a fund manager, when we look at markets, especially as an Asian fund manager, there's a lot happening in all the different markets. So we try to focus in on the companies we want to own from a medium to longer term perspective. So as Raamdeo mentioned, the markets, do their own thing. As he said, in February 2020, markets were at all-time highs. And suddenly by March, India had corrected quite sharply, as had global markets as well. So it's very important for investors to take a longer-term view on India. And I think India will continue to do well. You've got to be mindful, I guess, sometimes on valuations. You got to be careful. But if you take a longer-term view, hopefully you're invested and you can ride the different waves of the market, because nothing goes up in a straight line.
Sure. Thanks, Sanjiv, for that. Raamdeo, coming back to you, the most important thing for the Indian economy was the credit growth. And we could see actually the credit growth did see a significant impact down lower to a single digit. I mean, it was somewhere between 5 to 6%. From a double-digit growth, it has always been witnessed. Do you believe the credit cycle is likely to be turning favorable for India based on the favorable combination of policy and credit conditions that we are seeing, credit momentum rather?
Of course, it will improve from the current levels post-COVID. But if the demand is not built up, I think one of the biggest problem is that there is a demand destruction at the broad, that lower middle class and the masses level. And that's where the consumption is there. Consumption is not at the top of the pyramid. Consumption is there middle or below. And clearly below is hit very badly. So how can we repair that portion? One is in terms of income restoration or job restoration. Second, actually making their money buy more. So doing fiscal strategies in such a way in the budget or whatever that say you do say you halve the GST on the items which are needed only for that lower end of the population. For say 12 months or 18 months till the economy comes back. And at least make their income by 15% more. So that's some kind of a signal. I mean, this very rough kind of a thing I'm saying. But if you build the demand, because see, of the of the 3 capex cycles, corporate, government is full on. Corporate and household capex through the houses. So that is picking up, I would say. That is a big positive in India. But corporate capex cycle is completely profit driven. If there is no demand, if a motorcycle company has 60% capacity utilization, how do you expect them to put up other capacity?
Absolutely.
So I think not only the current demand, but the visibility of a sustained increase in demand, that leads the entrepreneur to see that he can put up the same capex cycle. So I would think that export is doing well. Export outlook looks to be good. Your housing looks to be good. But government is doing well. But the fourth component, which is very large, and that is a big swing factor in any economy, that is the corporate capex cycle. And that cannot come unless demand is surging, in the sense that demand has to be, and that's where the China example comes into play. If you read the articles in Mint or somewhere, they don't talk about negative interest and all. China talks about only growth. They said 3 quarters we grew at 8% or maybe more than 8%, and fourth quarter they come to 4%. And now they are going to against the world consensus. They are losing the policy. So, you need to stand up as a, I don't know whether India has those legs to stand up, but to say that, boss, come what may, we have to pay some price, but we will grow at 8%. And then the world will take notice, corporations will take notice, and they will do the capex. And that capex cycle itself will drive the thing. So there's ample money available, low cost money, but where is the demand? For whom to produce this? So I think that's so I would be, the credit growth, credit offtake is a, I would say, is a symptom, in the sense that whether economy is picking up in terms of capex. That's why you need that money. And that 5-6% has gone to 9%. That is because the capital cycle has picked up as the economy has opened up after a second wave. But I think going to 13, 14, 15% will require very robust, capex cycle from the corporate side. And that, to my understanding, demand is not supporting that kind of capex cycle.
Yeah, I think
absolutely,
Raamdeo, I just wanted to add, to what Raamdeo said. So, this income distribution and looking at rural India. So I guess that's one of the, looking at China, that's one of the issues of last year. The theme from the government was common prosperity, to make sure that income and wealth is more equally distributed. I know it's a different economic system, but I guess it's important everywhere to ensure that people have decent lives.
Absolutely, well said. And I really concur with Raamdeo, because he really clearly mentioned that the capex cycle, particularly coming from the private corporate space, will really push up the demand automatically, because that will give a residual income in the hands of the lower strata of the society, which will really put an effort to grow the economy. Of course, Raamdeo, I think we have already seen the government really concluding and pushing up by front-loading the capex expenditure. We have already seen it reaching around 29% of the GDP. So that is one of the very good signs. Coming back to you, Sanjiv, I think the corporate profitability as a percentage of GDP did see a rebound from the earlier average of around 1.7%, which was hovering for past 3 years. Do you see a meaningful setup in the corporate investment in the next couple of years, as Raamdeo was pointing out? Because we have seen at best only normalization from the pandemic disrupted period. So where do you see the corporate capex going? And of course, the final profitability as a percentage of GDP.
Yeah, sure. So we think, given all the measures that the government has taken that we've talked about before, demonetization, GST, so more steps to formalize the economy, fintech platforms, etc. So a lot more of the economy is getting captured in the records. So we think that, capex should go up. There are a lot of different schemes that have been set up. So lower corporation tax rates, that helps. The PLI scheme, incentives for companies to set up fresh capacity. And you're seeing a record number of companies being set up in India. And then you've got these new business models, whether it's e-commerce, so that's helping the so-called gig economy. So again, looking at workers, so enabling people to get a job and start earning money. If we look at corporate operating leverage, we think there's scope for that to go up as well. So we think that profits of companies should grow at a faster pace than the revenue or sales growth. So we think corporate India is in a good position. As Raamdeo mentioned, there are a lot of world-class companies in India, some very good entrepreneurs. And India is now attracting a lot of capital, be it domestic or foreign capital into new businesses. And I guess coming back to the stock market, which people are interested in, a lot of these companies are now listing on the market. So it's giving people a much broader breadth of opportunities when you come to invest in India. So you're getting these internet companies, you're getting alternative energy companies, you're getting the whole electrification, EV angle, electric vehicle angle. So as Raamdeo said, you could, you've got to compare it to the US, and you've got to compare it to China as well. But I agree, it's the private capex cycle that has to really kick off. So entrepreneurs need to be more confident that the demand is there and will pick up going forward. And obviously, as you get scale in domestic manufacturing, it leads to more export opportunities as well. And that's where we've seen, corporate India, we've seen the level of exports going up as well in the past couple of years.
Yeah, I think they have formidable expended on the exports. Last couple of months have been really good. Raamdeo, coming back to you, I mean, you did mention about the risk and flagged up some good amount of risk probably coming forth in 2022. So what kind of adjustments are you making in your fully managed portfolios to really hedge, or particularly maybe want to save the drawdown that you can see on your portfolios?
The question is very good, brilliant, I think. But how do you strategize? Because one side, when I'm saying China is loosening, so which way the market? The world is extremely rich. Now we're talking about $100 trillion of market cap, or maybe over $100 trillion of market cap. Unprecedented market capitalization. If by chance even a percentage or two shifts from DM to EM, I think if China gets $100 billion, India will definitely get $20-30 billion, because that has to have a thematic change that let's buy into risk assets that is called emerging markets. So in the process, of course, disproportionate money will go into China, but some 20-30% of that could come to India, and that can change because retail is on. The moment FIs become net positive, at what price, at what point of time they become net positive, what will trigger them, I don't know. But even 6 months of net positive by then, and retail will be on. That much I am very confident that retail will be on. And so you have a very interesting situation, very good corporate profits. I would say valuation, okay, upper end of say valuations, I would say, but not outlandish like 30-35 times. It's about 21-22 times. So yes, it is on a higher end, but still. So I would think that how do we handle the thing? So what we are trying to do. Yeah. So what we are trying to do is that we are trying to position where the growth is going to be as per our estimates. We have gone wrong in one or two estimates, like auto and all, where semiconductors completely spoiled the show and delayed the thing by 6-8 months.
Absolutely.
So to that extent, we have suffered, but we are trying to position in, say, things like financial services, things like your tech, Indian tech, and one of the, in fact, I would like to ask Sanjiv also about this China Plus strategy. There is like the entire chemical sector does just kind of a road in last 3 years. So what's your sense? Is it a very big move? The China Plus strategy. The world wants to have alternative kind of a sourcing place, and of course, other countries will also benefit. But to match China's outsourcing, there is only one country which can absorb some part, that is India. So, and the variety of the entire kind of a sourcing base from here. So, do you see, because more and more I talk to the entrepreneurs, they say that we are beneficiary of China Plus strategy, and their counterparts in US and Europe, they are pretty happy to buy more and more from whatever they can supply. That's the kind of thing I'm doing. So, because that can, see, China is very large. I think their exports are like $4-5 trillion. Almost 10x of our exports, and still surging by 15-20%. So it is literally the manufacturing hub of the world. And if we are able to see services side, we are in any case booming. If the manufacturing side also some slack can come here, I think then even the corporate capex cycle, if not for the domestic consumption, for exports, that can pick up big time. So, there are a lot of these puzzles So basically, we are focusing on the quality and growth. That's been our style. So we are trying to see that, because we don't do cash calls. So we're still not doing cash calls. And we have found that it is, right now, if you see me, I see clearly corrections happening, and I'm very clear, but I'm not going to do a cash call on our portfolios. That's not our style. We will take on the back.
Absolutely.
I only hope that our drawdown, as you said, is lower than the market drawdown. That's being hoped. But we are trying to find. Style remains same. We're just trying to see that at the margin, we are buying more growth at this price, and of course, quality has to be there.
No, absolutely.
sure.
You rightly said. Sanjiv, you want to take on the China plus one, of course?
Sure.
Yep.
Yeah, so I was going to say, I agree with Raamdeo. It's very hard to time markets. So it's extremely difficult to do that. On China plus one, yes, I guess supply chain disruptions have shown that you need to have more diversified supply chain. And we've seen over the past few years, yes, some of the manufacturing has moved from China to Vietnam or other countries in the region. And now we're seeing a lot more coming into India as well. So that is, that's a positive story, because it allows companies to set up capacity. They can cater to domestic demand, and they also have the export opportunity as well. So we see that happening. So when you look at our smaller cap funds that we run, we see a lot more opportunities in that space, in China plus one opportunities.
Okay, sure. Raamdeo, coming back to you, I think you have come out with the Wealth Creators report, and the foundation of wealth creation to buy any business is the price to buy at sustainably lower than the intrinsic value that you clearly mentioned, or the expected value. But the lower value or in the market, or the price in the market compared to the intrinsic value, may not always be true. It may be having some inherent negative quality, and that's why the market is pricing it lower. How do you actually differentiate between a quality company and that you have been always talking about, and one which is intrinsically valued at lower but inherently a very good company to get into your portfolio?
Yeah, so we have this framework of QGLP, quality, growth, longevity at reasonable price. So you are asking about the quality. Quality is about top business, good business run by good management. So good businesses, actually, there are two types of businesses. Businesses fundamentally are two types, good and bad. And a lot of entrepreneurs also don't know that there are so many businesses, and actually bulk of the businesses are hardcore bad businesses. Negative cash flow, very high capital intensity, and so those things. The return on equity, return on capital is inherently very low, and they tend to be higher with the help of a lot of leverage. So fundamentally, one has to figure out what is a good business. Is it able to earn, if your risk free is at about 10%, including equity premium? So 10%, can it earn 18, 20, 25%, or even higher? So that is fundamental. And unlevered return of 18-20%, that starts making us interested in the quality of businesses, because anybody who earns on a sustained basis more than 15-17% unlevered, clearly there is some magic is on. Now, what is that magic? We have to go and figure out. What is that competitive advantage the company has, which is not visible to the world at large, but we can. We have to go and talk to the entrepreneurs, because every company is piece of art. It's not homogeneous. So why TCS has 55% return on equity, and even Infosys of the world is at 30-32%. So why that difference is there? I'm not meaning that any difference is there, but still you have to go and understand maybe the capital allocation policy, distribution policy, or hiring policy, margin policy, asset turn policy. So you have to really go and sit with them and figure out. Of course, these companies will not talk to us that much. Only the analysts talk to them. But the smaller companies, you can actually go and ask anything. So understanding the companies from the quality of business, and then while doing that, you also see the quality of management. And when you see competence in the management and passion and highest possible equity, that's where the magic of wealth creation happens. Because in wealth creation, compounding is extremely important. And compounding will happen Only if the great business or good business are run by good management and lot of honesty, not lot of 100% honesty. So
Absolutely.
even very ordinary businesses run honestly, efficiently, it can create surprising amount of wealth in the marketplace, particularly in India. That I have seen, I have been holding some of the companies for 15, 17, 20 years. Very average companies, but very honestly run. They create a lot of wealth because you end up buying very cheap at the beginning.
Absolutely.
And if you hold on for 15, 20 years, the management is working day in, day out on a average business. I think they still create a lot of wealth.
No, absolutely rightly said. And that's where the saying goes, you have to be buying good companies at fair prices or not fair companies at good prices. So that is something which we will take away. Thank you so much, Sanjiv, and thank you so much, Raamdeo, for your time for this evening. And it has been a wonderful session. We have just overshot the time by a minute or just about there. So we will really want to close this, though there are a lot of questions actually flowing in. And I can really end up with the statement that of course, the government is doing its bit. The private corporates are doing their bit. Of course, it's the whole economy which is going whole hog with the kind of incentives that the government is providing, whether it is in the form of PLI or the liquidity that is being provided to the government. It is a long way to go for the markets, and we look forward for having you for more of such sessions out there. Thank you, Sanjiv. Thank you, Raamdeo. This concludes the session for the day.
Thanks.
Thank you. Thanks.